we see three things. So the big one is less regulation. Secondly, higher interest rates. And then third, we really see some momentum for fee revenue, which has really been powering the big banks that I cover. So the regulation is the big one, and it's not just some of the specific issues for the banks as a whole and one or two banks, but it is just, the feeling that the pendulum can swing the other way, right? So that there won't be new regulations and that some of the things that are sort of in the pipeline could be watered down or pushed out. So you were just speaking about Basel III. So that Basel III endgame has been the big one for the largest banks. And Basel dictates that all jurisdictions around the world have to do some form of implementation. But the U.S. proposal that came out in 2023 was really much stricter than we saw in other regions. We had already had some expectations that would be watered down from comments that Powell had made and also comments from Barr in September. So some of that was sort of in the stocks, but I think the feeling is, from our regulatory group, that the things could either get pushed further out or they could be watered down even further. And so that's good for the banks because their excess capital is something like 5 to 15% of their market caps. So definitely that was something aiding Citigroup and Wells Fargo, as well as someone like Morgan Stanley and Goldman, where even with the sort of lighter touch in September, they were still going to have a deficit in their capital. So some positive news on that front. Also, as Wells Fargo has had this asset cap for a long time. Citigroup, there's been some concerns, especially around when they reported their results, that they could face more scrutiny. So just a particular easing, I think, also benefited those couple of banks. And then there are some other things related to card and consumer finance as well. On the interest rate fronts, all these banks are positioned for higher rates. Yeah. So we know that we'll be watching the Fed in terms of short-term rates, but I think in general that also got a lift. And then finally, from our viewpoint, the big thing is that we see momentum in fees, and that's been a huge boost to the earnings for these banks. Just
back to the Basel III endgame rules, the idea is, give me the dummies version, you had to set aside more capital basically in case things went south, so the financial institutions wouldn't ruin the economy, right? So that's right, freed up. Does that now go back to shareholders? Is that the idea?
That is the idea. And so Basel III endgame rules, so as you know, Basel III is something that sort of came after the financial crisis, and there's been many iterations, thus the reference to this last set of rules as endgame. And basically what that dictated was that as they measure their risk-weighted assets, there would be big increases in that, and thus they'd be having to hold more capital against that. And so based on third quarter earnings and fourth quarter requirements, their excess capital was 5 to 15% of their market cap. Under the Basel III rules, that would turn to deficits across the bank. So they would have to find a way to increase their capital. There is a timeline, so they probably would have done that through internal capital generation. But to your point, that would have been capital that they could not return to shareholders.
Oh, can I just ask you, who has the most capital to be returned to shareholders?
Well, based on the requirements today, Citigroup, their excess capital is something like 15% of their market cap.